When we've spoken before, Will, you've said, look, there's a lot of drama around the trade story, but actually, if you look at equities, you still want to stay invested because earnings are holding up, etc. I mean, the first quarter doesn't necessarily support that story at the moment. And as we've been talking about, if the tariff impact gets more severe, then it is those profit margins that could take a hit. Are you starting to reassess your view on US equities based on that? And by the way, you know, we can show a chart showing that the first 50-day moving average breach of 2019 has happened for the S&P 500, and the 200-day could be in sight.
Yeah, so Nera, you make a great point. And we're definitely a little bit less positive on US equities. That has less to do with the trade war, to be honest, and more to do with just elevated sentiment and peaking profit margins in any case. And this just furthers that case a little bit, to be honest. Right now, if you're looking at stocks or looking at the world economy, there's just other stuff going on. So the interesting thing about last year and that kind of Santa swoon you saw in economic activity, that was primarily driven not so much by the trade war, but by Chinese authorities being a little bit too successful in their game of whack-a-mole trying to contain financial stability risks. Since then, they've been tapping the accelerator. You've also had the ebbing of those kind of fiscal juices that the US injected into the economy, the fiscal steroids. And so those effects were probably more important to date. Now, like you rightly point out, this trade war is now getting a bit more serious, or appears to be getting a bit more serious if we can't come to more agreement. That probably puts the trade war a little bit further up the rankings of things you should worry about for the next 6 months, if indeed we don't get some kind of agreement.
Yeah. Is inflation, and I know it feeds into the trade war story, but we've got the US CPI data coming later as well. Is inflation something that you're worried about at all this year?
Oh, God, it's so interesting. I mean, to be honest, this is one of the things just from market pricing that you should worry about, because it's something that markets aren't necessarily prepared for.
Yeah.
And the relationship between growth and inflation has always been a loose one, always prone to sort of confounding textbooks and commentators alike. There doesn't seem to be much inflation around. When people look at the wage story, even if you've got a higher wages going through, that takes a long time to even partially translate into price data. So right now, it doesn't look like there's much inflation, but certainly if you start getting tariff hikes and that gets passed through, as we probably suspect it will, or at least a good chunk of it, that starts to get you a little bit more like that. And that puts the bond market in an inappropriate position, I would say.
Yeah, but on the bond market, though, if you're not expecting much upward pressure from inflation and we continue to have just concern in global markets, the 10-year yield perhaps has a little bit further to fall, yet you don't find the 10-year Treasury attractive.
Not at all, no. I mean, there are ways you can, there are arguments you can make to buy the 10-year. They're just not very convincing to us, when put all together. Right now, it feels like real rates are low and it feels like inflation expectations are a little bit too meek. But, the bond market can sort of rightly, or bond market investors can turn around and say that inflation story is guilty until proven innocent to a certain extent.